So where are rates predicted to head in 2026? At the moment, Australia has high inflation. This is one thing the Reserve Bank's trying to control. Unfortunately, I don't think we're going to get that back inside their levels in this year. What that means is when the inflation data comes out in May and August, we are likely to have rate increases. So this means that throughout the year, we could have at least 2 rate increases, maybe 3, but 2 is probably likely. That's 0.5% interest rate hike from where we are. That's really what we should be at least anticipating this year. What does this mean for borrowers? For borrowers, it means that we need to start tightening our belt. You need to start putting a little bit of extra money away on your loan. You need to consider if fixing is a good option for you. And you need to stop spending that extra money that you're not needing to spend at the moment. Really, the tighter you've got a budget and already preparing for those higher rates is going to be better for you in the long run. Should you fix your loan? We've just been through a section where we've actually beat the bank for once. During COVID, we had really low interest rates, and when rates went up, borrowers were on an amazing rate for a while. It's very unlikely we're going to be able to beat the bank again. If we're looking to fix, we're looking to fix for comfort and for peace of mind. So really, if you're fixing, if a 2-year fixed rate is maybe already 50 points above the variable rate, are you going to win on that rate? Probably not. But do you need that comfort and that stability to know exactly what your repayments are going to be? If you have that, then you're comfortable because you know how much you've got to budget for the next 2 years. Are you going to save on interest? Maybe not. But if you need that stability, that's really what you should be looking at. A good test is put in an interest rate 1% higher than your current interest rate. If that would really impact your lifestyle and your budget, then maybe it's a good idea to fix now and lock in a repayment for 2 years. Will these increases slow the market, and is it still a good time to buy? Really, it is a very strong market at the moment, and with first home buyer changes, investors getting back in and a lot going through, we're still going to see a lot of demand over the next 12 months, even if interest rates increase. It might mean that some people won't go as high as they will, but the Australian property market is where a lot of us put our wealth. I think if you're trying to predict the market, you're just going to hold off and you'll miss out on the growth that you may have got. If you're really looking to invest in property or buy your first home, focus on being able to pay the higher repayment, and it's still a great time to invest or to buy your first home at the moment. When it is a good time to refinance your home loan? With mortgages, a refinance costs money. A good time to refinance is when you're looking to do something or your lifestyle's changing. And even if you're not looking to refinance, it's the time to review your mortgage. So if you're getting a new job, if you're having another baby, if you're moving houses, if you're changing career, lifestyle changes is a good time to review your mortgage, and whether that is to refinance, it might be, or it might just be to make sure you're in the good position. A review of your mortgage to make sure you're in the best spot is just as good as a refinance. What factors should I consider when I'm looking to refinance? When you're looking to refinance, it's always great to consider your existing loan term. You've already paid a few years off. Are you looking to reset that term? That can reduce the repayments, which some people are looking for. What else are you looking for? Are you looking for different features on the loan? Are you looking for possibly a fixed and variable rate? Are you looking for a better banking platform? You've got to consider what's important to you, because it's not always just the best rate we're looking for. It's making sure everything suits your lifestyle and being able to pay that loan off quicker. What are the costs to refinance? There had been refinance rebates in the past, but generally you should expect to pay the costs associated with refinancing. In most states, it would cost around $1,000 to refinance. There's a discharge mortgage with your existing lender, generally between about $350 and $500. There'll potentially be an application fee with your new lender, maybe $350 is a pretty standard fee. And then you'd also consider that there's a registration of mortgage at the titles office and a discharge of mortgage at the titles office. Every state has a slightly different fee, so it's just based on the state. There may be slightly interest adjustments when you refinance, but that's just interest you haven't yet paid that we just need to account for, because that will be added onto the refinance figure as well. What is debt consolidation? Debt consolidation is where you're combining one or more of your debts together to either reduce repayments, to reduce the interest rate, or to make it more comfortable for you. How can debt consolidation work? So debt consolidation, if you have enough equity, some people consolidate their debt into their home loan, and that way it can put that debt over a longer period and reduce the repayments. Sometimes that's not available because you don't have enough equity in your home. In that situation, debt consolidation may even be actually combining your debts into one personal loan or one facility, so then it avoids multiple payments and makes it easier for you to manage. It's not always about saving interest, it's more about making it more manageable so you can get that debt paid back and just focus on one thing to pay. When does debt consolidation make sense? If you've got more than a few bills you need to pay, then maybe it's time to put it into a more clearer bill that you can just focus on paying back. Sometimes when you've got more than a few debts, all you're doing is really just making minimal payments on each of them and not actually making a big dent. If you, for example, had 2 credit cards and a personal loan, combine that into one loan and put all the repayments and focused on clearing that at one time, you're going to get rid of that debt a lot quicker, even if it isn't exactly the best interest rate across all of those debts. It's about being able to consolidate it, focus on one thing and focus on paying it back. Things to watch out for when consolidating debt. When consolidating debt, you've got to make sure that there's no exit fees in the loans that you're looking at or the credit cards. Some car loans, you would actually pay all the interest even if you paid out early. So there's not a lot of point in consolidating that debt, because really, unless it's saving you on your repayment per month because you can't afford it, you're still paying the interest. You're not actually saving money. Some other things to watch out for is application fees when you're doing it. The interest rate might be cheaper across the whole debt, but how much does it actually cost to get into that loan? Some personal loans you may pay up to $1,000 or more as an origination fee, which can then reduce the impact of actually saving the money on that debt. If you're looking to put it into your home loan, how much equity do you actually have? If you're going to go above 80% of your property value, you would then have lender's mortgage insurance. That can increase your interest rate and maybe have a lender's mortgage insurance fee. Does that actually make sense? Putting everything into one repayment can even make sense. Sometimes we need to roll it into maybe a lender that isn't your first choice. They're going to do everything for you. You might be in a position that you need to save your credit file, give you actually a breather and just really put it into one repayment. In that instance, it might actually make sense to go for a higher interest rate for a short period, fix up your credit file, fix up your repayments, give you a break, and then we can refinance you in the future into a better interest rate once you've got a clean credit file and you're on top of everything. I hope that helps.